Hey guys, Fred Pacelli here. So today I want to talk about when you are going to determine if, as a taxpayer, you're going to take the standard deduction or if you're going to itemize this year. So to start off, the difference between the standard deduction and itemizing is the standard deduction is going to be a flat rate that all taxpayers will get. No additional work is required. So for example, 2024 tax year, that was about $15,000 for a single person. This rate or this amount is what you're going to get no matter what. You don't have to keep track of anything. You don't need any supporting documentation. You don't need to make any contributions, medical expenses, anything like that. That's the standard deduction. So we're going to use 2024 numbers for this exercise. So in 2024, standard deduction, $15,000. Now, the other area is if you don't take the standard deduction, you have the option to try and itemize. Now, you always want to take the higher of the two, whether the standard deduction is higher or the sum of all your itemized items are going to be higher. So when you itemize, this is when you're able to deduct certain things that you pay throughout the year. So examples of this would be mortgage interest, real estate taxes, sales taxes paid, medical expenses above a certain threshold of your adjusted gross income, and then also charitable contributions. So the sum of all of those, and there's a few other things that I didn't mention, but those are the main ones. So the sum of all of those has to be bigger than 15,000 for it to make sense for you to itemize over standard deduction. So the example I want to give you is if you're doing charitable contributions as of right now, 24 and tax year 25, that only sum up to maybe 1,000, and then you have mortgage interest of maybe 3,000, real estate tax 3,000, and let's just say that's it for now. So that's around 7,000. A lot of people are under the impression that you're going to be able to deduct those on your tax return, but you're actually not, because you're going to go the standard deduction route, which is 15,000. You would only actually deduct those if it's above 15,000 and it's advantageous for you to itemize those over the standard deduction. So an example would be maybe if you purchased a house in the last 2 years and your interest is 6, 7, 8%, you're probably going to have very, very high amounts of mortgage interest paid. Your real estate taxes are going to be very high. So if you're paying all of that, there's a strong chance that might be above the 15,000. So those are just things you have to weigh when you're deciding if you're going to itemize or do the standard deduction. And it also plays into the role, if you know you don't have high mortgage interest, you know you don't have high real estate taxes, and you also know you're not going to have a lot of medical expenses, then maybe it doesn't make sense to make all these extra charitable contributions you weren't going to do anyways to try and get a tax write-off, because it ends up not even being a tax write-off at year end. Now, charitable contributions is an interesting topic. In 2026, that's actually going to change. It's a new instance of where you can actually deduct up to 1,000 of charitable contributions, even if you're taking the standard deduction. So I'll discuss that more in a future video. But for right now, those are key things in determining whether you're going to take the standard deduction or itemize. Thank you.